So, okay, is it okay for my explanation? I will send something written anyway, okay, with an extract of the annual report I've been able to show. And I assume now that most people are there and we can go on. So having said that, I would like to come back to what we did yesterday, okay? So we did the most painful point in order to be able to structure leverage buyout, which means that we took into account corporate entities, the name of which is Swatch, for which we prepared the business plan. And when I'm saying the business plan, it's a set of three main documents, namely the income statement, the cash flow statement, and finally, the balance sheet. This is exactly what we did yesterday. Having said that, we are now going to come back to what a leverage buyout means, because except the fact that we included in our modeling a payout rate of 100%, all the exercise which has been done yesterday can be prepared by any firm, I should say, is prepared by many firms outside the context of the leverage buyout. I mean that when a group is presenting to the financial community its business plan, you necessarily have an income statement, a cash flow statement, and somewhere in the office of the CFO, I mean that it's not necessarily disclosed to the financial community, but it's been prepared, a balance sheet. So having said that, we are now going to determine the acquisition debt, which can be borne by a dedicated holding company in the background of a leverage buyout. For that, I would like to come back to this sheet, which reminds us what the leverage buyout is on a 100% basis. I remind you the principle, and I'm going to tell you what we are going to focus on in the coming seconds. The principle, as I said yesterday, is unchanged. You have a private equity fund, a financial sponsor, if you prefer, which wants to undertake 100% of the control of a firm, the equity value of which is 100, and for that, the PE fund is investing only 40. Is investing only 40 in the capital of the dedicated holding company. And of course, such a deal, such a leverage buyout is possible because banks accept to grant a loan, an acquisition debt for a consideration of 60, which enabled the holding company to raise funds for a total amount of 100, which enables to get the cash, which enables to pay 100 for 100% of the target shares. And at the end of the day, I can say, based on this simplified set of figures, that the PE fund is investing only 40 in order to take 100% of the control of a firm, the equity value of which is 100. So I have to say that we are going, firstly, today to deal with the first element of the simulation process, which means that we are going to calculate the acquisition debt, which can be raised by a holding from a pool of banks in order to buy the target being Swatch in our example. And I remind you what I said yesterday, this acquisition debt will be repaid. And interest on this interest-bearing debt will be paid mainly, not only, but mainly thanks to dividends that will be paid out by the target. And of course, there will also be a tax payment by the target. I will explain in the coming minutes. So we are going to prepare the business plan of the holding company as we prepared yesterday, the business plan of the target. Now we're going to be interested in the business plan of the holding. And I remind you what I said yesterday, what I repeated today. The business plan means income statement, cash flow statement, and balance sheet. And thanks to the balance sheet we will have in the coming 2 hours, we will be able to know the amount of debt which can be raised by the holding. So this is what we are going to do. So first of all, we are going to build the income statement of the holding company. I would like to remind you a few points, as I did yesterday, regarding the various documents we are supposed to prepare when we say that we want to have a business plan. I was looking for my file, but I remember that I have to find it here, just in order to be able to write down. So please keep in mind that yesterday we said 2.2 targets balance sheet, so 2.2 after 2.1, which was the principle corresponding to the graph I've just shown. So 2.3 will be the holdings balance business plan. So 2.3, going to write a bit as I'm used to doing. You remember now, 2.3 holdings. Holdings, there is only one which is necessary. Holdings business plan. And of course, as yesterday, 3 paragraphs. A, income statement. I have to tell you that everything will be more rapid to be prepared because we are dealing with a holding company. So if we speak about the income statement of the holding, what do we have in the income statement? Well, we have, so you know that here you have incomes and charge. Well, you know what an income statement is. So you have as an income the dividends received from the target. I think it's the main product, the main income, which is a financial income, and you have interests on the acquisition debt. In fact, only 2 aggregates, having said that, are missing. First of all, I have to say that as any firm, this holding is supposed to pay tax, corporate tax, tax to be paid to the tax authority. You've seen that amazingly. I started to write down tax on the right side of the income statement as if it was a product. But if I started doing that, there is a good reason for that. And I'm going to explain why. Because there is a tax here. But I need to explain before going on. I'm going to explain why I was about to write down tax on the right. Because normally we are used to paying a tax. So it's on the left part of the profit and loss accounts. We are not used to receiving a tax. I mean that the tax authority is used to receiving the tax, not a company. But sometimes it happens. And it will be the case for the holding. And this is what I want you to understand from now on. What I want to say, and I will need a paragraph which will be dedicated to that. I mean that there is a tax treatment. I need to explain, which may be a bit different from a country to another, but I have to say that in many countries, the principle is exactly the same one. I mean that tax. I'm going to explain. I would like to remind you what we have. We have the holding which is a 100% shareholder of the target. It's a no-brainer for everybody. I have to say that if you are the holding company, if you are the shareholder of a target, you can expect and you will get dividends. The famous dividends, which are there, paid out by the target to the holding company. And I would like to say that in many countries, probably also in Vietnam, dividends which are paid out by a subsidiary or by an affiliate are not taxed or taxed at a very, very low effective rate. I mean that each country has its own tax regulation, but the principle is not to tax meaningfully the dividends. Because if you tax too much, there is no incentive for entrepreneurs to develop a target. So, in France, you have a regime, a tax regime, which enables the dividends to be taxed at an effective rate which is just above 1%. In France, in fact, only 5% of the dividends received are taxed, which means that we apply in France the corporate tax rate, which is 25%, to only 5% of the dividends received. And 5% times 25% is equal to 1.25%, which means that the effective taxation, the effective tax rate of dividends in France is 1.25%. It could have been 0%. It's been the case in the past in France. So I mean that we have the following problem. And I'm not going to write down the French regulation because it's only interesting for French people. The only thing I'm going to write down is that dividends are almost, sometimes fully, depends on the country, tax-free, whereas interests on the acquisition debt are tax deductible, which means that there is an issue, which is that you generate at the holdings level a tax deficit which can't be used because dividends are either received tax-free or are taxed at a ridiculous tax rate. So it means, I'm going to write down everything the coming seconds, that the tax deductibility of interests on the acquisition debt, if you prefer the tax shield, will be lost. I mean that in many countries, the case in France, in the case in other countries, in other European countries, if you make profit, you pay a corporate tax. If you make loss, you do not receive any cash from the tax authority or from the state. I mean that you need to generate a tax base in order to be able to use the tax deficit, which is generated by the interest on the acquisition debt. It's the first point. The second point, and I will stop explaining just after that because I will need to write down all what I will have said. The second point is that from a tax point of view, the holding has a tax deficit, whereas the target of a leverage buyout is profit making. I mean that a PE fund would never be interested in a target which is not profit making today or which is not able to generate profits in the near future. So I mean that you have at the holdings level a tax deficit corresponding to the tax deductibility of interest on the acquisition debt, which is about to be lost, and a target which is paying a corporate tax and which would be very interested in the possibility to use the holdings tax deficit. But unfortunately, in many countries, what I'm saying is not correct in the United Kingdom, but in France, in Germany, in Spain, and so on, in many countries, you can't transfer your deficit to your mother company. And a mother company can transfer its deficit to its subsidiary. I mean that many countries do not want to enable to have a market for deficits, which means that it's not possible for the holding to use its tax deficit, except if there is a setup of a creation, a foundation of a tax group, which I will describe in the coming seconds, and which will be done by 100% of the leverage buyouts. So if I want to summarize what I have just said, I'm going to write down a few sentences. The first point is that in many countries, dividends received are tax-free or almost tax-free. I'm going to write down 5% times 25% is equal to 1.25% effective tax rate in France. This is the first point. The second point is that interests on acquisition debt are tax deductible. But the tax deficit can be used at the holding level as dividends are, I put almost between brackets because sometimes we do not need almost, it's really tax free. So the third point is that the target, I'm going to write down profit target, which is profit making, is paying a corporate tax and would have been interested in the transfer of the holdings tax deficit, which is not possible in many jurisdictions. So you understand, I suppose that you have a tax deficit which can be used and which is about to be lost. And in order to prevent from losing tax deficit, you have the possibility in many countries, when I'm saying many countries, it's of course valid for France, to benefit from tax integration. What does it mean? First of all, I feel like saying for point one that the shareholding of H in the target has to be minimum 95%. 95%. And when I'm saying that the target is 100% owned by the holding company, 100% is higher than 95%. So it's okay. Second point, we have the signing of a tax agreement, as we are used to saying, between, going to write between more properly, but you've understood, the holding, which is the mother company, and the target, according to which you have three provisions. First one, 421, or A, or let's say first bullet point. The target pays to H the corporate tax it would have paid if there had been no tax group. Right, properly, there had been no tax group. So this is why I was saying and writing down that the holding is receiving tax. I mean that the target pays tax to H. So it means that H is receiving the tax received from the target. So I mean that the target, as I said a few seconds ago, is undoubtedly paying dividends, but it is also paying tax to the holding company, which you can see in my sheet principle of a leverage buyout. So it is a first point. Okay, so just a second, because I would like to be able to change the color of what I'm writing down. Just a second. Yes, that it's not. Okay, just let me do that. Understand why it doesn't want me to be in the middle of the page. Aha. Okay, right. Let's do it that way. Okay, so because I wanted to go back to black. So having said that, so the target pays to H the corporate tax it would have paid if there had been no tax group, would have paid to the tax authority. To the tax authority. Second bullet point, there are only three ones. Second bullet point, the holding recalculates the taxable income for the whole tax group, which can be looked upon as holdings pre-tax profit or taxable income. Plus targets taxable income And of course, here we have a tax loss because I'm not going to include the dividends. I will only include the interest on the acquisition debt. And the holding pays corporate tax for the whole group. And I'm going to give you a simple example on a 100 basis, as I'm used to doing. And then we do the same with the real figures of Swatch. Let's take an example. Let's imagine that you have, let's say, an acquisition debt, which is what we're looking for, which is 1,000. Why not? We're going to say that the cost of debt is 4%, which means that interests will be 4% times 1,000. I do not need Excel to tell you that it is 40. The first point. The second point, at H level, mean that H is running into debt. The purpose of H is to run into debt. Please don't forget that we are dealing with a leverage buyout. It's a first set of assumptions. Second set of assumptions, we're going to say that the target's pre-tax profit i.e. taxable income, or E is equal to taxable income. Taxable income is 100. Let's say that the corporate tax rate is 25%, which is the case in many European countries, including France. Which means that the target is paying 25% times 100, which is of course 25, to the holding company. I'm going to say that if we have a tax group, it implies, first of all, that we have the payment by the target to H of 100 times 25%, which is 25. Second point, calculation by H of a taxable income for the whole group, for the whole tax group, which is, so we have the pre-tax profit of the target, 100, and we are going, thanks to this tax group, to benefit from the tax deductibility of interests, which means 60. And of course, third point, tax paid by H to the tax authority, to the tax authority. Also, I'm going to write more properly, but you've understood, to the tax authority, 25% times 60, which means 15. Yes. So what does it mean? It means, if I'm trying to summarize what I've just written down, I mean that H is receiving 25, payment by the target to H received by H, and tax paid by H, okay, 15, which means, you understand, that H is receiving 25 and paying only 15 to the tax authority. It enables me to say that you have a tax saving, which is the difference between what H is receiving, 25, and what H is paying, 15. I don't think I need Excel for that. It is 10. And I have to say that 10 is 25% times 40. I mean that thanks to the foundation of the tax group, we get to use the tax deductibility of interests on the acquisition debt. So you're going to tell me that it's different from the initial goal. I mean that I've also written down that the target would have been interested in the use of the tax deficit of H in order to reduce its corporate tax. And instead of benefiting from this tax deductibility, this tax saving, the tax saving is at H level, but it doesn't change anything because we have two possibilities from an economic point of view. First possibility, which is not possible from a practical point of view, the target is reducing its corporate tax and is paying more dividends. Second possibility, the target is paying the same corporate tax. Instead of paying to the tax authority, the target is paying to the holding company, and the tax saving is at the holdings level, which means that you have some additional cash, 10 in our example, which enables to increase the debt repayment at the holdings level. I mean that for the holding is the same in terms of repayment, of additional repayment of debt, if you receive more dividends or if you pay less corporate tax. So this is what's been found by investment bankers, by PE funds, lawyers, and so on, in order to enable the holding company not to lose the tax deficit, which is generated by interests on acquisition debt. I'm going to check if you have questions on that. Of course, as usual, I will send that at the end. And if not, I will do exactly the same in the coming seconds on the figures of Swatch. So I'm going to come back just a second on that. No question on my principle regarding tax group, tax integration? No, it's okay? So if there is no question, you will be able anyway to ask questions afterwards. But I'm going to do that with Swatch. Exactly the same. You can trust me. So I'm coming back to the leverage buyout sheet. I'm going to copy and paste as I'm now used to doing in order to define the table I'm going to prepare, which will be the holdings income statement. So what did I say for the holding? I said that we have, first of all, dividends received from target. We have interest. You remember that I'm used to signing my aggregates. Remember? And I put between brackets, it's a charge or a cash outflow. Interests on acquisition debt, which is what we're looking for. And I have to say that there will be a tax group. There will be a tax received from target. And there will be a tax paid to the tax authority. And at the end of the day, I will have the net income. So I will have the net income. In order to have the net income, I calculate the sum of all what we have above. I mean that all income is signed, every income, is signed positively, every charge is signed negatively, so I can calculate the sum. Right. So I have to tell you that we already have some information. Dividends, we know the dividends. I mean that dividends received from the target corresponds to the dividends paid to the holding company, namely this line. I'm picking this amount, okay, in the target's cash flow statement. A dividend which is paid out to H is signed negatively, it's a cash outflow. But when I'm in the income statement of the holding, it's an income. So if I want it to come positively, I type minus this negative amount so that it is positive. And for the sake of clarity, when you read the slides, I think it's better if I can put in a color, for example, this slight gray, the dividends which are there and the dividends which are there. Second point, I've said that the holding is going to receive tax from the target. I mean that instead of paying corporate tax to the tax authority, the target is paying to H. So I know that corporate tax is in the income statement on this line. So I'm going to pick this number, this amount, which is signed negatively in the income statement and which has to come positively because it's received by the holding. This is why I'm typing minus. And of course, I can extend in the end. And I'm going again to put some color so that it's more self-explanatory when you look at the slide. So I'm going to take this light yellow, orange. No, I can't because I've already used it for DNAs. So let's use this kind of blue, tax received from target, and the tax is there. What is the interest, the level of interest on the acquisition date? I don't know, because I don't know the acquisition date. This is what I'm looking for. What is the tax paid to the tax authority? Well, I don't know either. I will know in the coming seconds. If I want to know, I need to calculate, and I have to say that I need a new table just for the tax paid to the tax authority. So I'm going to copy and paste what we have here. And we are going to say that we have here H, corporate tax. So, well, I'm going to do what I've explained and what I've written down on one note. I have said that there will be a tax group which would be set up by H and the target. And I have said that H would calculate the taxable income for the whole group, taking the pre-tax profit of the target's pre-tax or earnings before tax is the same, earnings before tax, and it will be reduced by the interests on acquisition debt. Sorry. Interests on acquisition debt. Why doesn't it want to be copied and pasted? And I will get the tax group's taxable income, and it will enable me to get the tax paid to the tax authority. This is what I'm looking for. So again, we have a lot of information for that. First of all, target's earnings before tax. We have that in the target's income statement. Target's income statement, earnings before tax, you can see 1,132 in 2022. I remind you what I said yesterday. We are going to build leverage buyout for a closing of a deal at the end of 2021 which means that the consolidation of income statement will start in 2022. So you can see 1,132, and of course I can extend till the end. And I'm going again to put some color so that you can easily see where everything is coming from. Targets, earnings before tax, here. So having said that, we know that we have above interests on acquisition debt. I should say we will have interests on acquisition debt above. I mean that later today, you can be sure that we have the interests. So if we have them here, they will come here. I have simply equalized the two sets. And with an algebraic sum, targets earnings before tax minus interests on acquisition debt, I have the groups taxable income. Of course, at this stage, the tax group's taxable income is equal to the target's earnings before tax because we have no interest on acquisition debt. We have no debt, so we can't have any interest. But please don't worry, the debt will arrive. And tax paid to the tax authority, I may need to put the corporate tax rate, which has probably been put somewhere, 25%, okay? So, well, let's say that we have 25%, is a fixed reference. 25%, which is a fixed reference applied to the group's taxable income. And then you have for every year from 2022 onwards, the amount of the tax paid to the tax authority. This is what I was looking for in this table. I'm going to highlight that as I'm used to doing. Okay, here I'm looking for the net income, and here I'm looking for the tax paid to the tax authority. I remind you that I needed this line. You see this line? I'm going to put it in green because I need it here. I need this line, and I'm going to take it. I mean that I don't know why I didn't put it negatively. I forgot the minus. I'm going to put minus. It will be better. It will be consistent with the name of the aggregate, which has been put between brackets. And now I know the tax paid to the tax authority. I can put it in the above table. I'm going to say, well, we know the tax paid to the tax authority. And you can see, and normally you shouldn't be surprised by what I'm going to say. You can see that based on the calculations I've just done, for example, in 2022, I could take 2025, 2037, 2028. The conclusion would be exactly the same one. The tax received from the target and the tax paid to the tax authority have the same amount. Why? The reason is very simple. We've not benefited yet from the tax deductibility of interest on acquisition debt. Let's imagine that we have 100 here. You can see? Sorry, 100, which has to be signed negatively. Okay? You can see, in that case, the tax received is 283. The tax paid is only 258. What is the difference between these two amounts? 25. What is 25? 25% of interest on the acquisition debt, which are tax deductible. So everything is consistent, but no use putting a wrong amount, whereas we know that we can have a right amount. So now for the income statement, everything is ready. We only need the interest on acquisition debt. And in order to have the interests on acquisition debt, we would need the acquisition debt itself. And I would like to tell you that This is what I'm looking for. I'm going to say H acquisition debt. And I have to tell you that before the break we will have in, let's say, 5 minutes, we won't know the acquisition debt. We know it maybe in 1 hour, not before. But we are going to pave the way to get this acquisition debt. But before starting to pave the way, I'm going to check if there are questions at this stage regarding the simulation I'm doing. I mean that we're preparing the income statement. For that, we need the tax paid to the tax authority. And in order to know the tax paid to the tax authority, we need to calculate it based on the pre-tax profit of the target and the interests on acquisition debt, which are tax deductible. Are there questions or is it okay at this stage? No question, it's okay? So if it's okay, we may have a break now because it's not 5, so it's 3 in France, 3 p.m. So I suggest that we have 5 to 10 minutes break, and just after the break, we will start having a depth we will fine tune in the next hour. Okay? So it's okay, no question? Okay, so let's have the break now for about 5, 10 minutes. We're going to go on. So it's not that late for you, but it's not as early. Okay, so let's go on now. So, well, as I said just before having our break, is that we're looking for the acquisition date of H. So we need about 20 minutes before having it. But we're going to do as if we knew it. And then we will fine tune the amount. So we're going to say outstanding debt. And I'm going to take an amount just in order to be able to fill in the cells, to go on building our leverage buyout model. I mean that the amount I'm going to enter will not be the definitive outstanding debt. I would like to remind you that we're dealing with Swatch. Swatch has a market cap which is worth 13.4 billion at the time of the extraction of the financial data. Let's say 13 billion. 13 billion. If we have a huge leverage, we can imagine 20 billion for debt and 3 billion for equity. Again, everything will be calculated accurately. But just in order to start the calculation, we're going to do as if the purchase was 10 billion Swiss francs financed by debt. So I'm going to say, well, at the end of 2021, the amount of debt which is going to be raised by the holding company is 10,000. I know that this amount is completely wrong. It can't be the definitive amount. So I'm putting it in red just to think about the fact that I need to change it. Of course, I know it because it's what I'm looking for. But just for you to keep in mind that I've put 10 billion as I could have put 8 or 8.5 or 8,322 and so on. The advantage with 10,000 that it's easy to see what's happening in terms of calculation. Now, before going on, I need to provide some information regarding the acquisition debt. And in order to prevent from writing too many things, you know that you have here some information regarding the acquisition debt. First of all, maturity, 7 years. 7 years, which is consistent with the fact that, that we have here 22, 23, 24, 25, 26, 27, 28. I mean that you have here 2 years, and here you have 5 years. So at the end of the day, you have 7 years. This is why I went in 2028. Second important point, installments are flat, which means linear payments. Okay, so 1/7 every year. So let's say that we have here installments. I'm going to put that between brackets because it's a cash outflow. Installments, which will be every year the amount of debt which is raised divided by 7. And you have, as you can see, 1,429, which means that you repay 14.29% of the outstanding debt every year. It's flat installment. It's linear repayment, which means that every year the repayment will be, as I've just said, 1,429, 10,000 over 7. And thanks to the 1,429 yearly repayment every year, the outstanding debt is decreasing accordingly, which means that in 2022, I'm starting from the amount of 2021, namely 10,000. Normally, I should say I'm going to deduct the installment, 1,429, but as installments have already been signed negatively, algebraically, I add the negative amount. And I can extend the formula till the end. And I'm sure that nobody is surprised that as the model has been prepared properly at the end of the last year, the outstanding debt, the debt to be repaid is zero because everything has been repaid. So that's it for the repayment. But when we speak about a debt, we need an additional information, which is the cost of debt, the full cost of debt. And the full cost of debt is written down here. I need to explain because it's not a customary piece of information, probably for many of you. I mean that if you ask a mortgage loan to a bank because you want to buy your home, you will normally be announced a fixed rate. For example, in France, when you want to buy your home, your fixed rate is 1.5%. And whatever will happen in the future, I mean that Jerome Powell in the US, the head of the Fed, can decide to increase the reference rate to 5, 10, or 20%. You will always pay interest every year based on 1.5%. But when a corporate is raising a huge amount of debt, it can't be a fixed rate. It can't be a fixed rate because the bank doesn't want to bear an interest rate risk. I mean that when a bank is granting a credit to you, the amount of your loan is borrowed by the bank itself on capital markets. I know that there are deposits of clients, but they are not enough in general. Let's imagine a consumer credit entity. You have no deposit, which means that the cash which is lent to clients is borrowed by the financial institution on capital markets and based on floating rates, which means that the bank is refinanced based on a floating rate. There is no reason why it would be different for clients. Which means that in a loan agreement with a corporate or with a dedicated holding company in the background of a leverage buyout, you do not have the cost of debt, which is announced with a figure. You have a reference rate, which is a floating rate, an interest rate which is changing every day. In Europe, we have the Euribor. In many other countries, you have the LIBOR. And you have a spread because your interest rate will not be the Euribor. Euribor is about 0%, maybe less, minus 0.5%. And of course, the cost of debt is a bit higher. So you are announced in the loan agreement the reference rate, Euribor in Europe, LIBOR in many other countries outside Europe, and the spread. The spread which is fixed. Okay? But the problem is that if you have a floating rate, as it seems to be the case in what I'm saying, you introduce an additional element of uncertainty in your business plan, which is not possible for a private equity fund. So I've just said, and I can confirm that if you ask a loan for a consideration of 100 million euros or 1 billion euros or 10 billion euros, you will be proposed an acquisition debt based on a floating rate. But the bank will tell you, well, if you do want to have a fixed rate, it's possible. If you want a fixed rate, you need to buy a swap. And there is a cost for that. You want to turn your floating rate into a fixed rate, it's possible. I'm going to sell to you a swap. And the cost of swap has been, along the past 30 years, 1%. So I mean that at the end of the day, the full cost of the acquisition debt is a Euribor plus the spread plus the cost of swap. You may be surprised by the fact that I wrote down 6 months Euribor. I mean that you have 1 month Euribor, 2, 3, 6, 1 year Euribor. We are used to taking into account the 6 months Euribor for a very good reason, which is that banks are used to receiving interests and also installments every 6 months. We are not going to prepare a business plan semester by semester. We have only 1 column per year, but from a practical point of view, interests are normally due every 6 months. This is why the reference rate is the 6 months Euribor, which is changing every day, plus the spread, 3%, plus the cost of swap, 1%. And I can tell you that if we want to structure the leverage buyout in 2021, as I said several times between today and yesterday, we have to include the corresponding 6 months Euribor, which was minus 0.5%. So I'm going to put everything here. I'm going to say that I have the 6 months Euribor, which was supposed to be 0.5%, be a percentage. So I'm going to say it to Excel. You have the spread, which is 3%. And you have the cost of swap, which is 1%. Which means at the end of the day, that the full cost of the acquisition debt is equal to the sum you have here, and which will be 3.5%, of course. Sorry, I was thinking it was at HEC, where every laptop is in English, so sum in French here. 3.5%. And this 3.5%, thanks to the swap, can be taken into account for the next years, because we've swapped for a cost of 1%, the floating rate into a fixed rate. So I mean that for every year, we can stick to 3.5%. So even if the outstanding debt is wrong at this stage, it will be correct later today, of course. But keeping in mind that we have an outstanding debt, we can apply to this outstanding debt the cost of debt every year, which is 3.5%. And now we'll have the interest on the acquisition debt in the income statement, and therefore in the table which is dedicated to the calculation of the corporate tax. I'm going to repeat what I've just said, justifying the 6 months Euribor interest rate. Interests are paid every 6 months, twice a year. Hence, the calculation of interests based on average between the debt at the end of the year and the debt at the end of the previous year. Okay, so let's do it. I'm going to hide that just in order to be able to see all the required data. I'm going to hide that. Okay. And then hopefully we can see everything as is possible. So I'm going to say that interest, which we are missing so far, are equal to minus, I'm putting minus because it's a charge, it's a cash outflow, 3.5% times the average, so in French we say moyenne, but it is average, mean if you prefer, between the amount at the end of the year 2022 and that of 2021. And you have the interests. And I'm sure that nobody will be surprised to see two things. The first one is that interests on the acquisition debt are decreasing over time. I'm not surprised because the debt is repaid. There are installments. So the amount of the outstanding debt is lower and lower from a year to another. So if the outstanding debt is decreasing, interests are also decreasing. First point. Second point is that now we have interests on acquisition debt, which are deducted from the target's earnings before tax in order to get the tax group taxable income, which means that every year the tax received from the target coming from its income statement, the tax received from the target is higher than the tax paid to the tax authority, which means that every year you have a tax saving, which is lower and lower because the tax paid to the tax authority is higher and higher because the tax deductibility, or if you prefer, the tax deficit generated by the tax deductibility of interest on acquisition debt are decreasing every year because the amount of debt is reduced every year thanks to installments. So I'm going to repeat that 10,000 we have there is what we are looking for. I mean that we can say that we have finished and we found the outstanding debt. No, we are still looking for the right amount. So having done that, we're going to go on. We're going to build two other tables, the holdings cash flow. And then we will have in a few minutes, I can already pave the way, we will have the holdings balance sheet. And once I have that, I have the feeling to have the business plan of the holding. So I need to explain the cash flow of each. You can see, because I'm not discovering what the structuring of a leverage buyout is today, the number of lines is very limited, which means that the calculation of the cash flow statement of the holding will probably be very easy to be performed. This is what I need to explain from now on. So I remind you what we were doing here. We had a part, the name of which is the holdings business plan. We started with A, income statement, B, tax, and then we are going to say C, paragraph C. I may need to put here some refreshers regarding the acquisition debt before dealing with what I'm supposed to do, namely cash flow. I remind you what we said. Linear installments over 7 years, and the cost of debt 6 months Euribor plus the spread 3% plus the cost of swap 1% in order to turn the floating rate into a fixed rate, and therefore reduce uncertainty in the business plan. So now let's deal with the cash flow. First of all, I'm going to tell you that the cash flow, sorry to open a door which is already open, change in cash balance. Okay, the real cash flow, not a change in net debt, change in cash balance. I should say the change in net cash balance. So let's have a kind of refresher regarding the change, the cash flow targets cash flow, which was defined as a change in net debt. And here we will have the holdings cash flow change in net cash balance. So what did we say yesterday? We said that we had net income plus D&As less net capex less change in net working capital minus dividends paid to H. And we had the cash flow defined as a change in net debt. If you do not trust me, if you do not remember, look at what we have here. Net income minus dividends plus D&As less net capex and change in net working capital. So exactly what I wrote down in a different order. So first of all, we are going to say, of course, we start from the net income. Here it was the net income of the target. Here it will be the net income of H. First point. Second point, D&As. Will there be D&As? The answer is no. I mean that the holding has no asset to be depreciated, tangible assets, or amortized, intangible assets. So zero. No tangible asset to be depreciated or intangible asset to be amortized. So zero. Net capex, zero. No capex at H level. I mean that H has only been founded in order to run into debt, not in order to buy machines, factories, buildings, softwares, and so on. Net working capital, zero. No operating activity, which means no client, no supplier, no inventory, no inventory. So it's very easy. You have to add zero for the D&As, to deduct zero for the capex, to deduct zero for the change in net working capital, and I'm going to tell you that you will deduct zero for the dividends. So I was afraid I lost you, but okay. So, sorry. Okay. It's okay. You can't. I have the feeling you can't see me. What's happening? Okay, let's do it again. Partage. So, I think I need uh, to go out and to come back because I'm afraid I'm going to, sorry, to go out and to come back because I do not get to get my camera. So I'm coming back in, please wait 1 minute. It will be enough. It's impossible to get the camera suddenly. Hello? Hmm. Ah, camera. I do not get to get the camera again. I'm a bit afraid by that. So I think I need to start to do it again. Sorry. No, I do not need any. Don't know. I need to. I need to do it again, but it will take a bit more time, maybe 2 or 3 minutes, because I'm going to stop my laptop and. Wait, please wait. Sorry. Ça, c'est bon. Ça. Ah, I think the problem is solved. Yes, it is. Sorry for the interruption. So, well, I'm going to still recording, so it's okay for that. Sharing the screen. Okay. So now I'm going to be very careful not to touch any button on my laptop. So having said that, honestly, I don't remember exactly where we were, but I will know in the coming seconds. So I do not want to be on OneDrive. I prefer to be directly here. So, okay. And yes, okay, it was 2 minutes ago, so it's okay. So nothing has been lost. So, for me, okay. And, okay. So, yeah, no, we weren't there. We were dealing with the explanations regarding the cash flow. So we were there. So I was about to tell you. So I was about to say that amazingly, there will be no dividend. We need to keep in mind that we are no more at the same level. We need to keep in mind that initially we are dealing with the PE fund. I'm going to be very careful what I'm doing. We have the PE fund, which is having a 100% stake in H, which is having a 100% stake in the target. So I have said many times that H is receiving dividends from the target, which means that I can confirm that we have here dividends which are paid out to H by the target. But now, if we are dealing with dividends paid out by H, no more dividends paid to H, but paid out by H, this would mean dividends paid out to the PE fund. And amazingly, but I'm going to provide in the coming seconds a justification, the PE funds accept to receive no dividend. You are going to tell me it's a bit surprising. They want a huge internal rate of return. And receiving dividends would enable to increase internal rate of return. But if H decides to pay out dividends to the PE fund, it reduces the availability of cash for the service of debt. Let's imagine that all the cash which is available at H level corresponds to dividends paid out to the PE fund. There is no cash for interest payments on the acquisition debt and for the repayment of the installment of debt. So that it's a priority for a reason you will know in the coming seconds, for the holding company to be able to pay interests and to redeem, to repay the acquisition debt. The great issue is not to pay any dividend to the PE fund. I mean, the PE fund know that it's important for H to have cash to pay interests and to repay the debt. And for that reason, the PE fund accepts not to receive any dividend. So I'm going to write down no dividend. I'm going to write down acceptance, because it is a reality, by the PE fund not to receive any dividend in order to optimize the service of acquisition debt at each level. So we are not far from having the cash flow, change in net cash balance. Of course, when I present in the coming minutes or seconds the cash flow of H, I'm not going to have a line for DNAs to say 0. I'm not going to have a line for CapEx to say 0. I'm not going to have a line for change in net working capital to type 0. I'm not going again to have a line for dividends to say 0. But there will be another line which does not exist at the targets level. At the targets level, we've said that the cash flow was a change in net debt. And there is a cash outflow. You do not need to include when you calculate the change in net debt. I mean that the repayment of debt has no impact on the net debt. If you repay the debt, you reduce your financial debt, but you also reduce your cash. And that the net debt is the difference between the financial debt on the one hand and the cash on the other end. The repayment of debt has no impact on the net debt. This is why we did not include in the cash flow of the target the repayment of debt. It's because the cash flow has been defined as a change in net debt. But at the holdings level, we are not looking for a change in net debt. For a reason you will know in the coming minutes, we are looking for the change in net cash balance. And if I'm interested in the change in net cash balance, we need to keep in mind that if you repay the debt, you have a cash outflow. If you have a cash outflow, you reduce your cash balance or your net cash balance. So it means that it is justified not to include the repayment, the redemption, the installment of debt at the targets level, because the cash flow is a change in net debt. But at the holdings level, if I want to have a dedicated line in the balance sheet, the name of which is net cash balance, we need to include, and we will include, the debt repayment or debt installments. I'm going to write properly installments. So at the end of the day, we have the net income minus the debt repayment, debt installments, okay, which gives you the cash flow. So I'm going to write it again, just here, net income minus debts installments. Okay, no use highlighting it here. Okay, I simply have to say that we have net income minus debt installments. I'm going to write it more properly. Installments. So having said that, I think that I can prepare the cash flow statement of my holding company as we want. So in fact, net income minus debt installment. That's it. This is why the number of lines was limited. Net income minus installments. And I will have, I'm going to add one line anyway, and I will have, let's say here, and I can extend till the end, I will have the cash flow. So let's do it. So we've said that we needed the net income. I remind you that the net income is there. The net income, trying to optimize the screen. Okay, so the net income of H is there. Let's put it in this orange, for example. So the net income will come from above. So is equal to here, the net income we have there, 412. That's it. Installments are written above. I know they are wrong, but I can tell you that there will be correct in the coming minutes. And anyway, before the end of the course we have today. So let's pick this amount, minus 1,429 every year. Not very complex, so it's the same amount. And the cash flow is the algebraic sum. I said previously, net income minus installments. So net income, I'm not going to take minus because installments have already been signed negatively. So plus the negative amount of installments. And of course, I can extend. And I'm not very far from being able to fine-tune the outstanding debt. I'm not far from having the right amount of the outstanding debt. Okay? In order to have it, I have to tell you something. We need the balance sheet. This is what we're going to do from now on. So now we are dealing with the balance sheet of H. The advantage with H is that it's a holding company. It's a very, very simple company. So it's easy to have its balance sheet. Anyway, as usual, I will have a paragraph dedicated to the point. So again, I'm going to come back for a few seconds on one note. D was cash flow, and E will be the balance sheet. So we have the balance sheet of H. So what do we have? What do we have in the balance sheet? You have some shareholders' equity, and you have the acquisition debt we are looking for. What do we have on the left? On the left, we have, of course, the targets. On the left, I mean on the asset side, the targets shares, and we will have the net cash balance. And this is the level of the net cash balance, which will enable us to find the right amount of the acquisition debt, as I will explain a bit later today. Let's prepare that. Let's prepare the balance sheet before having a new break. And after the break, everything will be done. So. Well, I'm looking for my mouse, my mouse. Okay. So H balance sheet. So what do we have in the balance sheet? What did I say? We have the targets. Aha. It doesn't want me to type. It's a bit. What's happening there? Is there a new issue with Excel? Check. Okay. So use my mouse. Maybe better. Yes, it may be better with the mouse. Okay. So we have the targets. Another issue. Surprising to have that. So, 2 seconds. So we have the, I'm going to exit from Excel for a second. Okay. And say, well, where is my file? It's here. Let's see. It's another issue I can tape. So if I can tape, what's happening again? Let's go out. I can write here, so there is no problem here. Let's have it here. Okay. So I don't know what can happen here, which prevents me from not know. I don't know again. Let's see in another sheet if it would be better. I can write down. Okay. Well, what I suggest is that we have the second break now. We're a bit in advance, but I think that it's better for me to start again my laptop, which is completely new, so I don't know what happened. Okay, so we have the break now, and we will resume in 10 minutes. Okay. Of course, I need to exit. I'm going to start again my laptop. So don't worry, I'm coming back. Okay. 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 Sharing the screen. Okay. And about that, questions. Everything else. Perfect. So come back here. So the problem is solved. So I don't know why it happened, but anyway. So let's come back to where we were. I was saying that we wanted to have the balance sheet of H, and based on what I said, we have on the asset side the target shares. We have more than one share in general. We have the net cash balance. We will have a total assets. We will have shareholders' equity. Shareholders' equity. We will have the acquisition debt we are still looking for. But I can tell you that we have it in less than 10 minutes. And we have a total of the balance sheet. We are going to have that here. Okay. And, well, we are going to say that we calculate the sum of what we have above. Okay. And on the other side, we calculate also the sum. And I'm used to saying, and when we are not online, but we are in the same room physically, I'm used to saying, and people are laughing at me, I'm very proud to say that my balance sheet is balanced. And normally everybody is laughing because total assets 0, total equity and liability 0. Why I'm saying that? Just only for fun. I'm saying that the balance sheet is balanced. Even if there is nothing inside for still 2 minutes, just to say that the total is a total. The total is a total. I mean that I'm not looping on anything. It means that I'm going to include the assets, target shares, and net cash balance. I'm going to calculate shareholders' equity and acquisition debt, and we will check that the balance sheet is definitively balanced without cheating, as I already said yesterday for the target, which means without looping on an aggregate. So let's do it. So first of all, you remember, you can still see it. We have above an outstanding debt, which is supposed to be 10,000, and we know perfectly well that it will not be 10,000. Okay, this is what we are looking for, and we will get in less than 5 minutes. I would prefer to enter it here for a reason you will understand very shortly. So I'm going to format properly every cell, you see. So instead of entering 10,000 here, I'm entering it here. I'm going to put it in blue because I know that in a few seconds it will be correct. And of course, this amount is linked to this one. Okay, so I'm going to put it in black because it's a formula, a very complex Excel formula, is equal to. Okay, so we know exactly that the acquisition debt is entered here and will be correct. So we have the acquisition debt. We know that the acquisition debt is also provided here. Either I take that or I say it may be more user-friendly. I take what I have at the end of the previous year minus the installments, and for us, algebraically, plus the negative amount of installments is exactly the same. And I can copy till the end of our business plan. So copy and paste. So that's it. Shareholders' equity, it's also what I'm looking for. Let's say, for example, 5,000. I also know that this amount is wrong. And again, before the end of the course today, it will be correct. Okay, so let's imagine that we have 5,000. If you want to take 4, you can take whatever you want. Anyway, it's not the definitive amount. I mean that I am here assuming that the total funds raised is 15,000. If I can raise 15,000, I can pay 15,000 for the target shares. Yes, I can. If I can raise 100, I can pay 100. If I can raise 15,000, I can pay 15,000. And if I use all the cash I've raised to buy the target shares, I have no cash balance. All the cash is employed when you buy the target share. So you will always have zero here. It's the first point. The second point is that the target shares here have a net book value, which is at the beginning 15,000. Regarding a net book value, you have two possibilities from an accounting point of view. First possibility, the value is increasing every year. I can increase the net book value. I can revalue the net book value of the target shares every year because the value of the target is increasing over time. But in many countries, including France, when you revalue assets, you pay a corporate tax on the revaluation. So it's a pity to pay a corporate tax on an asset you've not sold. So for that reason, no firm with no tax deficit revalues its assets. So I mean that even if the market value, the economic value of the target shares is increasing, we do not increase the value. We keep the same net book value. Second possibility, the net book value is decreasing because, in fact, market value, the economic value of the shares is decreasing because the target is loss-making. And if you think that the value of the shares will decrease, you will have no leverage buyout. I mean that you do that on a profitable entity, on a profitable target, not on a loss-making target, which means that in the business plan you prepare, in the forecasted balance sheet you prepare, as we are doing now, you can't imagine any provision, any impairment of the target shares. If you think about that, you can close the file. You can forget the leverage buyout, which means that at the end of the day, that the value, the market value, the economic value is supposed to increase, but you will not increase the value in the balance sheet in order to prevent from paying any corporate tax, which means that in any circumstance, the net book value of the target shares will be unchanged. This is the first point. The second point is that the net cash balance has to be updated or included for every forecasted year. Please keep in mind, as I said yesterday for the target, that we are inside the balance sheet. In the balance sheet, we do not start from scratch every year. We start from what we had at the end of the previous year. I mean that the patrimony of the firm, it may be a corporate entity as a target, it may be a holding company in the background of a leverage buyout. The net worth does not vanish between the 31st of December and the 1st of January. So I start from zero and I add change in cash balance, which is the cash flow. Principle of the cash flow is to explain the change in net cash balance. So the new net cash balance is the net cash balance of the previous year plus the cash flow. And I can extend till the end. That's it for the asset side. And we will come back in the two coming minutes on that line, which is the most important one. But let's terminate the balance sheet. Shareholders' equity. Again, we are in a balance sheet. Shareholders' equity does not disappear, does not vanish during the night between the 31st of December and the 1st of January, which means that I always start from the 31st of December. In 2022, I start from 5,000, and I add the net income of the year, the net income of the year, which is here. And I remind you that the holding does not pay any dividend, pay out any dividend to the PE fund, which accepts not to receive any dividend, just in order to optimize the service of the acquisition debt. And you can see, amazingly with me, that the balance sheet is balanced. Of course, it's not balanced the next years because shareholders' equity is missing. But if I am copying and pasting the formula till the end, you can see that the balance sheet is definitively balanced. The balance sheet is balanced, but we do not have the answers to our two questions yet. First question, which acquisition debt can be raised? It's not 10,000. Which capital can be raised from the PE fund? It's not 5,000. I'm going to tell you something, just in order to have the acquisition debt in the 5 coming minutes. I have to tell you that the calculations you can see in front of you are correct. I mean that you have a balanced balance sheet, so it means that the calculations are correct, for sure. But there is something which is not acceptable by banks. For a reason I have not given yet, but I will give it in the coming seconds. I mean that the net cash balance is negative. What does it mean? I will write down all I'm going to say in the coming seconds. What I want to say is that we are speaking about a leverage buyout. I'm repeating, a leverage buyout. I mean that there is normally a huge acquisition debt. We're speaking about billion Swiss francs or euros, it's the same today. Okay. So I mean that there is a huge debt at the beginning. If the net cash balance is negative, as is the case here, what does it mean? It means that there is an overdraft. I mean that the net cash balance is the difference between cash and cash equivalents, but there is no cash equivalent at the holdings level of cash and overdrafts, which means that if the net cash balance is negative, that the holding company needs an overdraft, namely a new debt. An overdraft is a debt, in order to repay the acquisition debt. And it's not possible for a bank to accept, once the acquisition debt has been raised, to grant a new loan in order to repay the acquisition debt. So this is a constraint. And we are used to saying in loan agreements, which are signed between the bank and the representatives of H, that there is a covenant. And if the covenant is breached, I mean that if the net cash balance happens to be negative, all the debt has to be immediately repaid, which is not possible, which means the end of the leverage buyout. So I mean that I need to fine-tune the acquisition debt so that the net cash balance is always positive. I mean that if it's negative, it's because there's too much debt. So let's come back to that and let's try 5,000. It's better, but better. And it's acceptable only from 2024 onwards. Because in 2022 and 2023, it's negative. So I mean that there is too much debt. Let's try 4,000. Almost okay, but I mean that you need an overdraft in 2022 for consideration of 13, which is not acceptable. Let's try 3,500. Everything is positive. It's good. But we want to maximize the acquisition debt. 3,600. It's okay. 3,800. Still okay. 3,900. 4, we have still some possibilities. 3,950. It's too much. 3,920. You have the final acquisition debt. I mean, at the maximum debt which can be raised without requiring a new debt, namely an overdraft, in order to be repaid and in order to have interests to be paid, is 3,920. So now we know the acquisition debt. It is 3,920. I'm going to write down some explanations, as I'm used to doing on OneNote, and we will spend the last half hour to get the capital of the holding company. So let's have the customary comments regarding the acquisition debt. So I'm going to write down that the loan agreement includes a covenant which prevents H to run again into debt once the leverage buyout is structured, which means that the acquisition debt is calibrated so that H's net cash balance is always positive. Otherwise, net cash balance negative, H needs to get an overdraft i.e. a new financial debt in order to pay interests and or redeem the acquisition debt, which I'm going to write properly, which would breach the covenant. So this is what we've just done. And then we need the very last paragraph, which will be the paragraph F, which will be the holdings capital subscribed by the PE fund. Well, first of all, I said yesterday, when I introduced the principle of leverage buyout, that the PE fund was requiring a 20% internal rate of return. Required internal rate of return by the PE fund is 20%. Let's have a refresher about the internal rate of return. So I would like to remind you that the internal rate of return is the discount rate I'm used to writing down with the I letter, as many people in the world, so that the net present value is equal to 0, which means the investment of the PE fund is equal to the sum of the present values of cash flows where I is, as written down here, the internal rate of return. So I have to say that the formula looks a bit complex because there is a sigma, but I'm going to tell you that we are going to get rid of the sigma in the 2 coming seconds. First of all, I would like to say that the PE fund will probably exit, will probably sell its stake, its 100% stake in the holding company at the end of the 3rd year. It's not an issue to keep in mind that the maturity of the acquisition debt is 7 years. I mean, when the PE fund is exiting, the debt is not fully repaid. It's not an issue. I mean that the equity value will be reduced accordingly. So I'm going to say contemplated exit by the PE fund at the end of the 3rd year. And I have to keep in mind that the internal rate of return is 20%. It's not the unknown. My unknown is the investment of the PE fund in H capital. This is what we are looking for, which means that I0 we are looking for is equal to CF1 over 1 plus 20% plus C power 1 plus CF2 over 1 plus 20% in the power 2 plus CF3 over 1 plus, I'm going to write more properly, but you understand, CF3 over 1 plus 20% in the power 3. So first good news, there is no more sigma. We have only 3 terms. But we need to keep in mind that the 20% required internal rate of return is required by the PE fund. What is the first cash flow received by the PE fund at the end of the 1st year? 0. Because the PE fund has accepted not to receive any dividend. So no dividend received by the PE fund. I've said why. I've said that it's in order to optimize the service of debt. Then CF1 is equal, I'm going to write down more properly, implies CF2, which is equal to 0. There is no dividend in the year 3, but there is the exit year 3, which means at the end of the day that I0 is the exit price over 1 plus 20% in the power 3. So you're going to tell me, it wouldn't be stupid, that we've moved the problem. We've said that we wanted to have the entry price, the investment of the PE fund in its capital, and in order to have that, we need the exit price. This is what we're going to calculate from now on. And once we have the exit price, we calculate its present value, the discount rate being the internal rate of return, which is required by the PE fund, namely 20%. And we have the investment of the PE fund, and therefore the capital, the initial capital of the holdings. And then we have the price of the target in the background of the leverage buyout. So this is the last point I wanted to mention on OneNote. I will send that at the end, of course. But before performing the calculation, I'm just checking that there is no question. It's okay? We can move to the calculation, the last ones, of course. And you have the full model. I have exchanged that model, of course, with other figures on other firms, with Carlyle, with Apax Partners, with Cinven, with the main PE funds on the marketplace. No more calculation. It's exactly what I want to see. So let's do it. I'm checking that it's still recorded and everything is okay. So let's have a very last table for today, which will be H capital. Capital. Okay, so we're going to start with the calculation of an EBITDA multiple. Because if we speak about the exit of the PE fund in 3 years, we have to keep in mind, I did not say it, I'm saying now, that it will be based on either an EBITDA or an EBIT multiple. Normally, we do not take into account the multiple of sales, EV to sales, because the problem of sales is that it does not include any reference to the profitability. So I can tell you that PE funds are focused on EBITDA or EBIT. You can do whatever you want. So let's remind the market cap of the target. Targets market cap. It will be more self-explanatory. Targets market cap. What is the market cap of Swatch? When we are preparing that, listed peers, you can see 13,432 million Swiss francs, or if you prefer, 13.4 billion Swiss francs. This is the market cap. It's coming from another sheet, so I'm supposed to put that in green. Let's put the targets net debt in 2021. Nobody will be surprised that I'm going to look for this aggregate in the targets balance sheet. Luckily, everything is ready here. Targets balance sheet 2021 minus 500. And then if I calculate the sum, nobody will be surprised that I have the enterprise value. Market cap plus the net debt. 12.9 billion Swiss francs, or 12,932 million. Let's put the EBITDA here. EBITDA in 2021. The EBITDA in 2021 will for sure be found in the income statement, targets, income statement, EBITDA, 1,390. And based on that, we can calculate the multiple EV to EBITDA, 12.9 divided by 1.4 billion, 9.3. This is the EV to EBITDA multiple when the leverage buyout is studied, prepared, or structured. We are going to assume that the market status of the firm is unchanged. What does it mean? It means that the multiple of EBITDA, I would say the same for the multiple of EBIT, for a P, multiple of whatever multiple. If I am assuming that the market status of the firm is unchanged, the EV to EBITDA of the current year will be always the same one. I mean that if it is 9.3 in 2021, 3 years later, 2024, it will be again 9.3. So this is a strong assumption. Stability of the market status. I'm going to write it down. Assumed stability of the firm's market status, which means that on the long run, the prospects in terms of growth and operating profitability will be the same ones. Okay, so if you have the same market status, you understand based on what I've just taped that the EV to EBITDA multiple is unchanged. And of course, this EV to EBITDA multiple will be applied to the corresponding EBITDA. I have copied and pasted the formula for EBITDA of 2021. You can see that in 2021, we are picking the EBITDA of the target on the line number 6, column number D. Okay, and if I'm copying and pasting that, okay, we get the right amount for 2024. And nothing prevents me from applying the EV to EBITDA to the EBITDA of 2024, namely EBITDA times the multiple, which is 17.3. EBITDA times the multiple is the enterprise value. So it is 17.3. The difference between the year 2021 and the year 2024, beyond the figures we have here, beyond the fact that there have been some growth, EBITDA, probably an increase in the operating profitability, is that in between, there has been the leverage buyout. There has been the setup of the holding company, which means that the buyer of H will get H's debt plus A plus the target's debt. I mean that I'm never interested by principle in enterprise values. I'm only interested in equity values. And you've learned in other courses, probably in the courses which are taught by Alain Chevalier, that equity value is the enterprise value minus the net debt. And I remind you that the P fund, which wants to exit, the P fund, I don't need to be there, I can be here, the P fund is selling the holding, which is a 100% shareholder of the target, which means that the buyer will get a holding, which is consolidating the target, which means that the net debt we have to account for, and I will account for in the coming seconds, is a consolidated net debt. I mean that if the P fund is exiting, no debt can disappear. Of course, you can merge. This is generally what happens, the holding and the target. But if you merge two entities, you add the assets, you add the debts. So at the end of the day, the net debt, which has to be deducted from the enterprise value to get the equity value, is a consolidated net debt. And I'm going to calculate it very easily. I mean that I know the target's net debt, and it will take 1 minute to calculate the holding's net debt. The target's net debt is, of course, found in its balance sheet. You can see target's balance sheet. 2024, we have a net debt which has been calculated and which is 700, 2024, 733. That's it for the target. For the holding, we do not have the net debt. We do not have the net debt because we wanted to have a breakdown of this net debt between an acquisition debt on the right side of the balance sheet, corresponding to the outstanding debt, and the net cash balance on the left side on the balance sheet, I mean on the asset side, just in order to check that this line is always positive, just in order to check that you do not need any overdraft to pay interests on this acquisition debt and to repay or redeem the debt. So we are very happy to have the net cash balance here, which enabled to fine-tune the acquisition debt. And now we need the net debt, and we know that the net debt is acquisition debt, net less or minus, if you prefer, the net cash balance. So let's do it. We have here the acquisition debt. and I will deduct the net cash balance. And if I have that, we take the figures in less than a minute, I will have the consolidated net debt. So let's do it. Acquisition debt, 2024 acquisition debt. It's here. This is acquisition debt. 2,240. The net cash balance, which has to be deducted, net cash balance, 539. And if you can see what I've done. And at the end of the day, the consolidated net debt will be the sum of these three elements, which means the consolidated net debt, which is 2.4 billion Swiss francs, or 2,435 million Swiss francs. So we have the enterprise value, we have the consolidated net debt, so we have the equity value. We have the equity value, which will be the exit price. So the exit price is the enterprise value minus the consolidated net debt. I can put the formula because I have enough place. EV minus consolidated net debt. Right. So, having said that, we are going to say that we are dealing with a P fund which requires an internal rate of return which is 20%. And at the end of the day, if we want to have the P fund investment in H capital, you simply have to calculate the present value of the exit price, taking the required internal rate of return as a discount rate. If I'm coming back to what I've just written down, I0 investment of the PE fund in H capital is the exit price over 1 plus 20% required, targeted if you prefer, internal rate of return in the period 3 because the exit happens or is assumed to happen in 3 years. So I'm going to say that it is equal to that exit price over 1 plus the required internal rate of return in the period 3. I would like to remind you that it is exactly what I was looking for in this part. So again, we could add a line just for the sake of clarity. And you can see that, of course, I calculate the present value of the exit price, the discount rate being the required internal rate of return. And if I have that, if I have the P fund investment in the holdings capital, now I can terminate the modeling because now I know the capital. I mean that the firm H is founded for the leverage buyout purpose at the end of 2021. When you found a firm, the capital is equal to the shareholders' equity. I mean, when the firm is founded, there is no retained earnings. So for that reason, we can say that here, the shareholders' equity, which is equal to the capital when the leverage buyout is set up in 2021, will be 8,618. And now its a formula, very complex formula, is equal to what we have below. I'm going to put that in yellow just for you to be able to see easily where it's coming from. And now everything is correct, of course. Every balance sheet, the balance sheet of H, the balance sheet of the target are balanced. They were already balanced. but now they're correct. I mean that the formulas which had been entered were correct, but beyond that, now we have the right amounts. What does it mean? What is the conclusion of that? The conclusion is that based on the business plan we had for Swatch, based on the very limited set of data in green, as you can see, based on customary assumptions for the soft ending of the business plan. Our holding company, which would be founded by a PE fund, which would be the 100% or the sole shareholder, can raise an acquisition debt for a consideration of 3,920. This is the maximum debt which is consistent with no negative net cash balance. So first of all, acquisition debt, which can be raised for a consideration of 3,920. Moreover, based on this business plan, based on the required internal rate of return by the PE fund, I'm going to write it down, assuming an exit in 2024, namely at the end of the third year, the total capital which can be raised by the holding company is 8,618 in yellow, which means that the total funds which can be raised by the holding company is 12,538. If I was to discuss with a PE fund about Swatch, I wouldn't say it is 12,538 million. I would say it is between 12 and 13 billion Swiss francs. But the accurate calculation is here. The holding, based on the business plan of the target, which is taken into account by bankers for the acquisition debt, which is taken into account by the PE fund for the capital. Total funds raised is 12.5 billion Swiss francs, 12,538 million, which means that the maximum price which can be paid for the target shares is 12,538 million, which means that the value of Swatch in the background of a leverage buyout is 12.5 billion. So you could tell me, terminate. It's amazing. It's lower than the market cap. I've already heard that. I've not heard only that. I have also heard, if I am the shareholder of Swatch, if I know that the market cap in green is 13.4 billion, I will not accept a deal with a PE fund for a consideration of 12.5. I prefer to sell my shares on the market. Unfortunately, what I've just said is completely wrong, or at least impossible. I know that Swatch is listed. I know that. It's because it's listed that we can have a market cap. No problem on that. You've already heard about the fact that as a shareholder, you have some liquidity on your shares if the firm is listed. But this is true. If you want to sell on the stock exchange, 0.5% or 0.8% of the total number of shares in the firm's capital. But given the volumes of transactions on the stock exchange every day, which is maximum 1%, if you are a 20 or 30 or why not 80% shareholder of a listed firm, you can sell your stocks, you can sell your shares on the stock exchange because the demand is not enough. And if you put all your shares on the market, If the demand is not enough, I'm not going to say the demand is not enough. The demand is not enough based on the stock price. But if you want to sell all the shares, you may find buyers, but at a price which will be meaningfully lower, which means that you can say that you have the liquidity if the firm is listed. You have liquidity for your stocks, for your shares, if you want to sell 0.2, 0.3, 0.5%. Otherwise, you can't. Which means that if a PE fund was to have a meeting with the founding family, the name of which is Hayek, of Swatch, if you were the PE fund or the investment banker advising on the buy side, the PE fund, you would say to the representatives of the Hayek family, well, you have two possibilities. Either you sell to us your company for a consideration of 12,538 million, let's say 12.5 billion Swiss francs, or you keep your shares. Because the market does not have the capacity to enable you to sell all your shares without having a collapse of the market cap and then of your net worth. So I mean that generally, there are exceptions, but generally, the valuation of the target in the background of leverage buyout is lower than the market cap if the firm is listed. And it doesn't mean that you would find no shareholder who is ready to sell, because the shareholder knows that even if the firm is listed, it's not possible to have an application on the market corresponding to the disposal of all your shares without having a collapse of the share price. So this is what I wanted to say. And of course, based on that, I can easily, of course, terminate. I will do it directly because I only have to copy a few things. I can terminate the slides, and then you will have the full modeling. I mean that we are expecting here to have the income statement. All what I have said regarding the tax group is described here, probably with the same sentences, because I wrote it by myself. Okay, so here you can see that you have the income statement. What do we have afterwards? No, we can also put here the acquisition debt. So we have here also the acquisition debt. Okay, I'm going to fill in the potential blanks, if any. Okay. Of course, you find exactly it's been prepared, of course, accordingly. So that's it for the income statement, the corporate tax, and the acquisition debt. Remember the maturity, linear installments, the cost of debt. Then here we are expecting to have the cash flow and the balance sheet. So the cash flow, which is there, and the balance sheet, which is just below. Of course, the balance sheet is balanced unamazingly for the balance sheet. There. So put it properly now. Okay. Then I've written down fine-tuning of the acquisition debt so that the cash balance is always positive. And we found 3,920. I were in billion here, so we will say 3.9 billion Swiss francs. And price of the target in the background of the leverage buyout is equal to the total amount of funds raised by the holding. And we've seen that the total funds raised, or the value of the target shares, is 12.5. So circa 12.5 billion Swiss francs. And to terminate here, I putting the detailed calculation of the investment of the PE fund in the holdings capital, or if you prefer, the capitalization of the holding. As you can see, so I may reduce, for the sake of clarity, what we have here. And you recognize what I've said regarding the exit at the end of the third year, i.e. in 2024. You can see that we suppose that we have an unchanged market status, which means same EV to EBITDA over time, consolidated net debt to be deducted in order to have the equity value, and investment to be looked upon as the present value of the exit value. I remind you that 8,618 is 14,892 over 1 plus 20% in the first 3. And the very last point I did not mention, but I'm going to say it now, and it's written down here, is that I'm saying that the PE fund contemplates an exit in 2024, namely 3 years after its entry. How is it possible to exit? In fact, 3 possibilities, according to me. First one, the IPO. Second possibility, the preferred one, the sale to a strategic player who will probably accept to pay a part of the synergies it will be able to generate thanks to the acquisition, or other possibility, the sale to another PE fund via a new holding company, and we are used to speaking about a secondary leverage buyout. And based on that, you have all what's necessary to structure, to prepare, if you prefer, a leverage buyout. So I will put everything on Canva afterwards. I can do it immediately. I can do it, but I'm not. I will do it afterwards because I'm afraid to lose the connection. But well, it will be put in the 5 coming minutes. We're going to stop, except if you have questions. I hope it's okay. I do not see any question. Of course, you have the possibility to ask questions tomorrow, because we have our last course tomorrow, which is supposed and which will be dedicated to real options, which is a different topic. But of course, before dealing with real options, if you have questions on what I've done, I've prepared, I've sent tomorrow, please don't hesitate. No questions for today? I understand that it's already 10 p.m. for you. But, well, no question? So if you have no question, we stop for today. And I'm going to tell you good night because it's 10 p.m. And see you tomorrow, same time. No question? I'm seeing that somebody is writing something, so I'm going to wait because it may be a question. Le message ci-dessous. No question today. Goodbye, sir. So goodbye, everybody, and see you tomorrow. And I'm putting everything on Canva right now. Ça, c'est files. Voilà. Alors, upload. Slides. C'est bon. Ah oui, il faut d'abord que je sorte. D'accord. On va sortir de ce truc. On va sortir de ce truc. Bien sûr. Donc, upload. Replace. Upload. Slides. Replace. And to terminate that. Okay. PDF exporté. C'est pas bon ça. Autrement. Ah oui, c'est là, d'accord. Ok, ça, on s'en fout. Je m'embête, ça. Ok, bon. Comment je peux me débarrasser de ce truc? Je sais pas. Ouais, comme ça. Et...
You are currently the only person in this conference.